What's up, y'all? With the market on its grizzly down over 17% year to date, we're starting to see two sides develop regarding the potential ways to move forward in a market and economic time like this. A couple of my friends asked me recently if it's a good time to get into the market for the first time, and I'm a little biased because my answer will pretty much always be yes, but for anyone wondering the same, today we're going to argue both sides of the coin. You're watching Stagflation, and today we're talking about the big picture. To invest or not to invest? That's the question. Now before we continue, we'd just like to remind you that this channel is meant for general education purposes only and is not meant to replace legal or financial advice from a paid professional. When it comes to investments, it's always healthy to take everything with a fair bit of skepticism regardless of the source, and that includes us. So for that reason, nothing we say here should be taken as a basis for investment, and you'll have to do your own work and thinking before deciding whether or not taking up a position on any stock mentioned here is in your best interest. Want to know how? Well, if you scroll down a tiny bit and hit the like and subscribe buttons, we'll do our best to help you figure out how to figure out this game for yourself. And with that, let's get to it. Alright, so before we get to the two main points, don't invest and invest, I want to drop a fundamental consideration that's key to any financial decision making with regards to personal finance and personal money management. And the question that I want to address right here is, what is your time horizon? In short, a time horizon just refers to the length of time you intend to keep your money parked to capture a return. So for example, if you're 25 and you're investing for the purpose of building a retirement fund that you expect to cash out at the age of 55, then your time horizon in this case is 30 years. If you're looking to save for a new car in 5 years' time, then your time horizon shortens significantly. Generally, the shorter the horizon, the safer the investment should be, i.e., things like high interest savings accounts or short-term bonds that don't put you at risk of losing your initial investment. Now, it's important to not only know what your time horizon is, but to also stick to that horizon when managing your money for the long term. So with this in mind, let's get back to the main question at hand. Is it a good time to get into the market? To answer this question, I'm going to turn to the late great Jack Bogle, who has probably done more for retail investors than any and all fund managers combined through his creation of the index fund.
The bad years, the crisis years, the Dow dropped by about 50%, and since then it's, and people panicked and got out, of course, even in the mutual fund business, and particularly in the ETF business, a lot of net liquidations at the lows. And now we're back. I think the gain from that level is maybe 200%. So it shows you that when you act on the emotions of the marketplace, you're making a big mistake. I stay, and always have said, stay the course. Don't let these changes in the market, even a big one, that was a 50% decline. Don't let that change your mind. And never, never, never be in or out of the market. Always be in at a certain level. You may want to be 50% in the stocks like I am. You may want to be 75% or 25%. That's probably a decent range. But never be out and think you can get back in, because your emotions will defeat you totally.
Alright, so this is the main position that I maintain as I go about investing for the long term. There's no reason to move in and out of the market because in the long term, and as long as market capitalism remains the economic ideology of the world, the market does and will continue to provide outsized returns in the long run. So with this as a fundamental viewpoint, I believe that now is a good time to get into the market because it's always a good time to get into the market. Is it a better time to get into the market than when we were at the bottom of the COVID crash? No, probably not. Is it a better time to get into the market than at the peak of the bull market last year? I mean, theoretically, yes. But the thing to remember is that without a crystal ball to tell us what will happen in the future, all we can do is base our decisions on historical precedent. And historical precedent is clear about the benefits of investing in the market early and consistently, regardless of where the market is at currently. Now, I should note that Jack was talking about investing in an index fund here rather than individual stocks, which are fundamentally more volatile and unpredictable depending on the stock you choose to invest in. However, I believe that the principle still stands for stock investors as well, as long as they remain well researched and that they understand the companies that they're buying, and also they stay up to date with the activities of those companies and all that fun stuff. But with this out the way, let's talk about the other side of things. Why not to buy? To be honest, this is a lot more fun to talk about because who doesn't love a good tale of the sky is falling? Alright, so let's start with the biggest worry pertaining to the stock market and general economic growth in Korea, stagflation. Now, if you don't know what that is, we did an explainer on the concept a few months back, but basically it's a combination of the words stagnation, or slow to no economic growth, and inflation, or the progressive increase in costs and devaluation of currency. Early in May, there was a number of reports, such as this one from Pulse, warning about the risk of stagflation in our economy in the back half of this year. Now, we've already seen significant inflation, and in this visual, courtesy of KDI's June monthly economic report, we can see that consumer-side inflation has been increasing every quarter since the third quarter of last year, due to factors including but not limited to another year of tie-ups in the shipping sector, heightening trade tensions internationally, and, of course, the situation in Ukraine and Russia, leading to an inability to trade with two significant trade partners. In addition to this, stagnation may become an issue as the Korean won has weakened significantly in the past months, and borrowing is becoming increasingly more expensive as the BOK continues to raise interest rates in the interest of cooling down borrowing and inflation. Now, all of these macro-level factors are continuing to affect the overall growth outlook for companies in the Korean market, making the purchase of Korean stocks significantly less attractive than, say, savings accounts where both the principal and interest rate are guaranteed at increasingly higher rates. Stagflation worries from early last month have been seemingly confirmed by the Korean Economic Research Institute, who claimed in a May 25th seminar that the country is already in a state of stagflation. So, given that markets and stocks grow with the growth of an economy and our economy is seemingly slowing down, many people, including some of my investor friends, are looking at this as a time to either pull out of or invest outside of the stock market. In addition to all of this, South Korea's trade deficit is rapidly expanding, with our total imports dropping 12.7% year over year to $15.1 billion in the first 10 days of June, with our imports jumping 17.5% to just over $21 billion over that same time. Now, in addition to these macro level considerations, there are more simple reasons that retail investors are shying away from the market as of late, such as a lack of liquidity as a result of massive inflation, increasing interest rates, potentially having been burned from investing when the market was at all-time highs, and while this is simply conjecture, many may be reeling from the massive losses sustained in the crypto market, which, while generally unrelated to the stock market, has been a stable investment for many in the country since Bitcoin's boom back in 2017. All things considered, the macroeconomic situation is making the near future apparently bleak for Korean firms and their corresponding stocks. The microeconomic realities for many retail investors is making the market look less appealing in the short term as well. Now, considering both of those factors, it's really not difficult to see why one may be fearful when approaching the market as it is right now. But having already evoked one investing great, it may be time to invoke another. As Warren Buffett is famous for having said, the best way to make money in equities is to be fearful when others are greedy and greedy when others are fearful. Looking around, everyone seems pretty damn fearful to me. Now, it's key to remember that none of this is financial advice, and for obvious reasons, I'm going to be on the pro-invest side of things, so definitely do more research before investing in this market, but me personally, I'm just going to continue investing. One thing though is that when the market's dropping, it can be difficult to identify if you're catching a great deal or a falling knife. Actually, this is something that I might get to soon, so if you're curious about how I go about vetting stocks in this kind of environment, why not do me a solid and hit the subscription button and come back soon. No pressure though. Life is hard enough as it is without having to hear my voice more than once in your life. Alright, that's it for me. If y'all got any questions or suggestions for things that I need to cover or that I should cover, let me know in the comment section below. Otherwise, be easy, fam. Peace.